You're welcome back. Now let's look at the next requirement of this question, which asks us to prepare a revaluation account and a goodwill account. Okay, now let's prepare our revaluation account. So we have our revaluation account opened. Remember, on a credit is the surplus, while the debit represent the deficit. Okay, so from the journal, you will see the first item there was the surplus on the freehold premises. So the revaluation surplus was credited. So let's credit the revaluation account with the freehold premises of 2,000. So we have freehold premises and it was 2,000. Okay. The next is the revaluation surplus on the machinery and tools. And you will see that it was 900. So let's credit the revaluation account with machinery and tools, 900. So we have machinery and tools, 900. Okay, the next is the revaluation surplus on the furniture and fittings. And it was 1,100. So let's credit the revaluation account with 1,100. So we have furniture and fittings, 1,100. Okay, those were the revaluation that occurred during the year. There were no revaluation deficits. So let's balance this account. You will see that the total on the credit is 4,000 and we have no item on the debit. That shows that the profit on revaluation was 4,000 and this 4,000 would be shared among the partners equally because they share profit or losses equally. So let's have share of profit on revaluation. Okay, A will have 1/3 multiplied by 4,000, which is the profit on revaluation, and that gives 1,333. B we have 1/3 multiplied by 4,000, and that will be 1,303. And C will have 1/3 multiplied by 4,000, and that gives 1,303. So the two sides are equal, 4,000 on the debit, 4,000 on the credit. Let's go on straight to the goodwill account. Remember, they told us in the question that the value of the goodwill is 8,000. And firstly, you will debit the goodwill account and you credit the partner's capital account with a share of goodwill in the old profit sharing ratio. So let's do that. Share of goodwill in old profit sharing ratio. A will have 1/3 multiplied by 8,000, and that is 2,667. Okay. B will have 1/3 multiplied by 8,000, and that will be 2,667. And C will have 1/3 multiplied by 8,000, and that will be 2,667. So with these, we will have increased their respective capital account or their respective capital with their share of goodwill. Thereafter, we will remove the goodwill from the books because goodwill should not show in the books of account unless it is a purchased goodwill. This is not a purchased goodwill, so let's remove it. Now we'll be removing it in the new profit sharing ratio. A has left, so B and C will share all profit or losses equally. So share of goodwill in new profit sharing ratio. So B will have 1/2 multiplied by 8,000. Okay, and that is 4,000. And C will have 1/2 multiplied by 8,000. And that gives 4,000. Okay, you will see that A will not have a share of goodwill to be removed because you have given him his own share of goodwill as part of his final settlement because he's leaving the firm. That is why he will not have any share of the goodwill again going forward. So let's balance this account. Of course, 8,000 on the debit, 8,000 on a credit. So this is how you prepare the revaluation account and the goodwill account for retirement or death of a partner. There is no difference between this and what we did before. It is substantially the same. Thank you very much. See you in the next video.